Fiber Finance, we seek out the hidden gems in cryptocurrency. We will tailor your portfolio to work for you. Are you ready to transition your investments from traditional markets to cryptocurrency? Are your coins staked and earning interest? Are you overwhelmed with all the jargon in crypto? Is your portfolio underperforming and you want to reposition into consistent winning blue chip coins and viable projects? Do you feel like you missed out on DeFi, Metaverse, and NFTs? Here at Fiber Finance, we provide you with the data, skills, and tools you need to stay on top of the digital asset market. Fiber Finance, we are the future of crypto.
What's up, everybody? Thank you for tuning in today. Have a really good one for you. Not going to be talking about any coins in particular today. Just going to be covering some really interesting articles and some news that I was digging up over the last couple days. I just wanted to take a quick look at the bubbles, and I mean, sure enough, when I'm not talking about a coin, we got green across the board. I mean, I swear every time I pull this up, it's just bloody red everywhere. But it's nice to see. We got Hex, a little pump up to about 4 cents. There we go, just over 4 cents right now. Love that. So shout out all the Hexicans out there and everyone that's making money in the markets today. But the thing that I wanted to talk about was starting off with this speech here from the acting chair of the FDIC. It was super interesting because a lot of the wording in here from all the research I've been doing, it's so clear what they are, who they're referring to with it. You know, there's certain things when you hear bank the unbanked and certain things we'll cover. I'll go over it. But just starting off, so this was from the acting chairman of the FDIC, and there was a lot of interesting stuff in here. So I kind of want to go through and just dissect this speech because it kind of gives you a good picture of where these guys are coming from in the FDIC as, you know, bankers and insuring deposits. So they say credit cards, mobile payments, remote check deposits, online bill pay, and all that have transformed the financial landscape. They've generally been a benefit to both banks and consumers. Each of these innovations share an important element. Each begin with a social, financial, or economic need to be addressed. Now that right there is some wording that sounds some bells right away with the whole ESG narrative, the environmental, social governments, basically the same thing, you know, environmental, social governance, social, financial, economic needs. Technology was then developed for the express purpose of addressing the specific need. These innovations have served to foster accessibility to the banking system, increase the convenience for consumer engagement in banking transactions, and enhance operational efficiencies of banks and banking industry. At the same time, these innovations were designed to operate in a manner that is safe and sound for banks and that provides important consumer protections. It's worth keeping in mind that innovation can be a double-edged sword. Subprime mortgages, subprime mortgage-backed securities, collateralized debt, and credit default were considered financial innovations that would serve the interests of both consumers and banks in the early 2000s, yet they ended up being at the center of the financial crisis in 2008. So right here, this brings me to the subject of today's program, crypto assets. I'll rely on the definition used in the recently published digital asset report by the Financial Stability Oversight Council. Advocates of crypto assets and the distributed ledger technology on which they rely have represented that these assets and technologies will increase financial accessibility and convenience for consumers and operational efficiencies for banks. At the same time, they will bring with them novel and complex risks that, like the risks associated with the innovative products in the early 2000s, are difficult to fully assess, especially with the market's eagerness to move quickly into these products. And basically, they're talking about how fast innovation happens. You know, a coin comes in, and then the technology shifts, and all of a sudden it's something else. Then they also talk about how there's 21,000 assets over 526 exchanges. Right here. So first, I'll provide a brief overview of the FDIC's approach to engaging with banks as they consider crypto-related asset activities. Second, I'll discuss the potential benefits, risks, and policy questions related to the possibility that a stablecoin could be developed that would allow for reliable, real-time consumer and business payments. So the FDIC is approaching with banks, and they're basically asking them if they engage in crypto activity. It was really interesting. So, from the perspective of a regulator, before banks engage in crypto asset related activities, it's important to ensure that each specific activity is permissible under law, yada, yada, yada. And also, this is important, it includes those related to anti money laundering and countering the financing of terrorism and consumer protection. So, the whole AML KYC thing, that's what they're talking about there. What's up, Tin Top? Thank you for stopping by, my man. Just covering this speech from the acting chair of the FDIC from a couple days ago, and it is super interesting with what they're trying to do with the payment stablecoins. All right, so where were we? The FDIC has been generally aware of the interest in crypto-related activities through its normal supervision process. But as interest is accelerated, we recognize that we lack sufficient information on the risks associated with these activities, as well as on which banks have been engaging in or interested in engaging in crypto. To address that gap, in April this year, the FDIC issued a letter asking the banks that the FDIC supervises to notify us if they are engaging in or planning to engage in crypto asset related activities. If so, we ask the banks to provide us enough details to allow us to work with them to assess the risks associated with the activities and the appropriateness of their proposed governance and risk management processes associated with the activity. So basically, the FDIC is just asking banks if they plan to engage in crypto related activities. So if you were a bank right now and you were engaging in these activities, and you didn't have to report this, would you? Or if you had, shell companies around the world that were buying up crypto through Tornado Cash and without any trace of it, would you really be reporting that to these guys? So that kind of rang some bells for me and tells me that there's so much going on right now that we just don't know about. This clearly reflects a cautious and deliberate approach by the agencies to bank participation in crypto asset related activity. We're doing this for several reasons. This here is where it gets interesting. To the risk of these activities to safety and soundness, consumer protection, and financial stability. The lack of history and familiarity with these assets, both in the marketplace and within regulated financial institutions. You need to only read the news to know that these risks are very real. After the bankruptcies of crypto-related platforms earlier this year, there have been numerous stories of consumers who have been unable to access their funds or savings. So they really are looking out for the average person here. I thought this was going to be very one-sided, but it wasn't. In addition, false and misleading statements, either directed or implied by crypto entities concerning the availability of federal deposit insurance for a given crypto asset product violate the law. I mean, that was Voyager and the whole misunderstanding with people thought that their money was backed by the bank in New York that was custodying it, which was not true at all. It was not insured at all. So Voyager was misleading their clients there, which that I agree with. When these exchanges are doing that and misleading their clients, that can't happen. So there needs to be regulation. I mean, it's I see where it can be the death of crypto, but also where it can really help. Insured institutions need to be aware of how the FDIC insurance operates and needs to assess, manage, and control risks arising from third-party relationships. So again, that just talking about Voyager there and how people basically were misled and lost all their money. So this is where it really starts to get interesting with stablecoins. So Bitcoin was the first widely known crypto asset designed to operate on a public distributed ledger system employing blockchain technology. The purpose of Bitcoin was the development of alternative crypto or alternative currency system free of the control and free of the need for banks and governments. Neither Bitcoin nor ETH are backed by physical assets, but rather they purport to establish value by their scarcity or utility. As such, the value of these crypto assets at any point is driven in large part by market sentiment. This has resulted in a highly volatile marketplace where fortunes have been made and lost overnight. As investors traded in and out of various crypto assets, a desire arose for an asset with a stable value that would allow investors to transfer value from one asset to another without the need for converting it in and out of fiat currencies. This gave rise to stablecoins. Most stablecoins are represented as a back pool of assets or utilize other methods to help maintain a stable value. Currently, the most prominent stablecoins are purported to be backed by the financial assets as currencies, US Treasury securities, or commercial paper. Like the concept of money market mutual funds, many types of stablecoins seek to maintain a stable value of $1. Thus far, as I previously stated, stablecoins have been predominantly used as a vehicle to buy and sell crypto assets, and there's been no demonstration so far of their value in terms of the broader payment system. Now, this is where it gets interesting with payment stablecoins, and I haven't heard of this before. This is new lingo to me. Even if crypto assets and stablecoins have yet proven to be a meaningful or reliable source of payments in the real economy, the distributed ledger technology upon which they are built may prove to have meaningful applications and public utility within the payment system. We're at a pivotal point with this new technology and asset class, much as we were during the free banking era in the late 1800s and early 1900s, as the financial system came into being. So back then, there were as many as 1,500 currencies circulated at one time, from banks, notes in gold, silver. This decentralized form of monetary exchange led to numerous bank runs and cycles of bank failure. While our financial system has advanced significantly, we do well to keep our history in mind. It offers a valuable lesson about the risks of private money, both digital and physical, for the US financial system when we consider more than 21,000 crypto assets. There has been considerable discussion and public debate regarding the benefits and risks associated with a payment stablecoin, both for domestic and international cross-border payment purposes. Now, that right there is Ripple. That is one of their 3 use cases right on their website, international cross-border payments. So the main benefit given for that stablecoin is the ability to offer cost-effective, real-time, around-the-clock retail and business payments. On the domestic level, this is similar to the benefits proposed by the Federal Reserve's FedNow system that is scheduled to come online in the coming year. So that Fed wallet we've been talking about for a while now, and the extent to which a payment stablecoin would provide additive or complementary benefits to the FedNow system remains to be seen. Nonetheless, there may be merit in continuing to examine the potential benefits associated with payment stablecoins. To be clear, I see the notion of payment stablecoins as conceptually distinct and separate from the existing broader universe of stablecoins, and designed specifically as an instrument to satisfy the consumer and business's need for safe, efficient, cost-effective, real-time payments. And again, on Ripple's website, on-demand liquidity and real-time payments is one of their 3 specialties. So you can really start to see where Ripple's use cases are literally word for word in this speech. So there are three important features that could make payment stablecoins significantly safer than stablecoins currently in the marketplace. So what they want to do here is usher in a new stablecoin on top of the whole CBD system that the Federal Reserve is going to be doing. So first, payment stablecoins would be safer if they were subject to prudent regulation. One vehicle for ensuring regulation and separation from deposit taking would be the issuance of a payment stablecoin through a bank subsidiary. There you go. Second, the payment stablecoins would be safer if they were required to be backed dollar for dollar by high quality, short dated US Treasury assets. So that I'm going to go into this in a little bit, but this was I didn't realize that this is what the bond market is collapsing right now. So what are they doing now? Let's usher in this new payment stablecoin and let's just buy all the bonds with it, and it kind of covers up the bleeding there. So third, a payment stablecoins would be safer if they were transactioned on a permissioned ledger systems with a robust governance and compliant mechanism. The ability to know all parties, including the nodes and validators that are engaging in payment stablecoin activities, is critical to ensuring compliance with AML and countering of terrorism and deterring sanction evasion. So that's interesting right there. I was watching Wales on the Hex this morning, and he was talking about how Ethereum now is no longer decentralized. Validators can basically choose to shut each other off, I guess. I'm not sure exactly how it works, but I mean, that right there, you're starting to see the writing on the wall for centralization hard. So these three features would make payment stablecoins safer, there remain several important policy considerations that should be taken into account when examining the benefits and risks associated with payment stablecoins. Sell the shitty bond. Yeah, Tinta. Yeah, just wait, bro. It's really interesting what's going on. I got a couple articles after this that kind of tie this all together with BlackRock and Coinbase and everybody. It's kind of crazy, man. I'm glad I found this. There's a couple more things I just wanted to talk about here. And where was it here? Right here. So when we consider where payment stablecoins should fit into the regulatory landscape, we must also consider the manner and extent to which states should charter stablecoin issuers or license them as money transmitters. Many states have invested considerable time and effort in understanding the risks. All payment stablecoin issuers should, just like the banks, whether federal or state chartered, be subject to prudential regulation and oversight. As I mentioned, the potential for non-bank stablecoins to disintermediate community banks from their local communities is an issue that should also be carefully explored and considered. These stablecoins could exhibit many of the features and vulnerabilities associated with money market mutual funds. As we've seen previously in stress market conditions, large investors could quickly exit their holdings, leading to a fire sale of pricing of underlying securities and panic selling by other investors. This could result in a contagion across other payment stablecoins and similar pooled asset holdings, resulting in a systemic event. Where was it? So consideration must be given of a payment stablecoin to foster more inclusive and accessible banking system. A payment stablecoin and any associated hosted or custodial wallet should be designed in a manner that eliminates, not creates, barrier for low to moderate income households to benefit from a real-time payment system. Further, additional studies should be undertaken to see if design features that could provide incentives for greater participation by unbanked and underbanked households. Again, they are literally putting Ripple's terminology directly into this paper. I mean, if you go right to Ripple's website and click this little globe right here, you see their cross-border payment, their use cases, cross-border payments. And when you come down and you click here, enable faster payments, lower cost payments, cross-border. I mean, it's literally word for word what Ripple's doing. So it's really interesting to see that plug directly in here. And then again, I'm seeing how it ties all together with BlackRock, Coinbase, and Sam Bankman-Fried. And BitBoy is right, with his rant. Just wait, there's more. If you act now, we'll double your order of junk bonds, plus free shipping on orders over $1 billion. Oh man, this is gonna get really interesting, bro. So this is their base. They want this a payment stable coin to appropriately interact with the Federal Reserve upcoming FedNow service, as well as the potential of a U.S. central bank digital currency. The federal banking agencies have a significant breadth of authority when it comes to addressing safety and soundness and financial stability risks associated with crypto, including perhaps payment stablecoin issuance by our regulated entities. However, there are clear limits to our authority, especially in certain areas of consumer protection, as well as the provision of wallets and other related services by non-bank entities. We must consider the extent to which legislation would be necessary to provide cohesive framework to prudentially regulate a payment stablecoin system from end to end and ensure that consumers are appropriately protected in the process. So, in conclusion, I have sounded several notes of caution. It's important for the FDIC and banks and agencies to approach crypto assets and activities thoughtfully. We must understand and assess the risks associated with these activities the same way we would associate risks related to any other activity. However, the risks associated with crypto are novel and complex, so the assessment of these risks will take time and a significant amount of dialogue with multiple stakeholders. We will continue work with our supervised banks to ensure that any crypto activities they engage in are permissible banking activities conducted in a safe manner in order to meet compliance. We'll work with banks to ensure they put appropriate measures to control and identify risks. So there's light at the end of the tunnel. There may be benefits associated with a payment stablecoin, especially to the extent that it fosters an inclusive real-time payment system. So basically, it includes Ripple and their technologies, and they piloted it all with MoneyGram in 2019 when Ripple bought MoneyGram. They rolled out all their technology and let them use it, and their cross-border payments and their transactions grew like 160% year over year. So that was the test run to see if this was going to work. And that's Stellar is actually taking over the micropayments, and Ripple is going to be, the CBDCs and cross-border payments, and XRP is going to be that bridge asset for liquidity. However, there are important risks and policy concerns that will need to be taken into consideration before a payment stablecoin is developed. To the extent that it is developed, it should be designed in a manner that complements the Federal Reserve's FedNow system and the potential future development of the CBDC. I think I already read that. Sorry, but this is interesting because they know the risks here, and they see that you can't just crush this industry. They know how important the .com boom was, and I really do think that they're going to meet in the middle. I watched Kinetics yesterday with Corey on his stream and just talking about how important it is to meet with your local politicians and just put this stuff in front of them and make them understand that this is the future. So, that this was good that you're not seeing just what Gary Gensler and these guys are doing at the SEC, just dropping the hammer on everyone. They know basically they're going to use Ripple, and they're going to slowly integrate the fiat system with this new payment system. And the next article I want to talk about was MakerDAO votes to custody 1.6 billion in USDC with Coinbase. So this right here is very, very interesting. So Coinbase will custody $1.6 billion worth of MakerDAO's USD stablecoin with its institutional grade service. The proposal was ratified with 75% of the votes in favor Monday afternoon after Coinbase Institutional submitted it on September 6th. This USDC represents 1/3 of the Treasury backing the peg stability module, which allows users to deposit collateral in exchange for DAI. Maker will not pay a fee, and the community will need to vote on whether it keeps its fund custodied with Coinbase after the trial period. So I'll pull up in a second. This was interesting though, because right here, MakerDAO's governance was trading at 96.20 on Monday afternoon, down 3% the past day and down 16% in the last week. Both DAI and USDC could use a boost. The stablecoins saw their market caps drop by 11 and 12% over the last month. This means these stablecoins have likely been cashed in for fiat or another currency, since both issuers create new tokens when they're bought in and burn them when they're exchanged. Earlier this month, Maker announced that it would invest $500 million in short-term US Treasury bonds. So there you go, right there. Blockchain seems to work fine in centralized systems, 100%. And these guys are going to this guy Rune Christensen right here says it perfectly. This makes today's Coinbase news another move towards centralized entities and assets, which seemingly runs counter to the remarks made from MakerDAO's co-founder Rune Christensen that DAI should divest from USDC. So he's saying it right there. He knows that he needs to divest from USDC. When the U.S. Foreign Asset Control sanctioned Ether Mixer Tornado Cash this summer, he took issue with how eagerly USDC issuer Circle blacklisted the 38 wallets on the list and froze USDC in them. Circle wasn't technically required to freeze the funds, but CEO Jeremy Allaire wrote in a blog post that it was right and our obligation as a regulated financial institution. So the CEO is just going to use the law as an excuse. I had to do it. It was the law. It was the law. And he did not have to do it. So right there, you see that Maker's co-founder is telling you right there that this is a move towards centralization, and do not do it. Now they can freeze your funds. So this was another article about the same thing. Can MakerDAO really safeguard decentralization by buying U.S. government debt? So we just talked about how they're buying the $500 million. Up to 80% will be invested in short-term U.S. Treasuries. $160 million will be allocated to the 0 to 1 year U.S. Treasury iShares exchange traded ETF, and $240 million to the 1 to 3 year. Then $100 million will be allocated to the investment grade corporate bonds offered by Bailey Gifford, an Edinburgh-based investment management firm. Very interesting. So while the plan to purchase government debt to stave off bear market seems laudable, there are also concerns about rising centralization amid current market situation. Committing $500 million for an asset worth $9 billion in total cap is quite the significant undertaking. And for DAO, which depends significantly on decentralization, this could threaten the current structure. So I think the writing was on the wall. They saw what was coming with legislation. They saw how much was being used. Right here, MakerDAO's shaky finances also posed a problem. This week, Masari Research reported that revenue fell about $4 million, a downtrend of almost 86% over the previous quarter. This would mark the DAO's first quarter of net income loss since 2020. So that right there, was the writing on the wall, and they saw the ship sinking, and the same thing with the bond market going to shit. So what's the best way that we can all save each other? And just, I'll blame Circle and Jeremy Allaire. You blame the laws. We're a bank now. Sorry. And then, it's everyone has a scapegoat. So really interesting. But I wanted to go look. I looked in. I'd never heard about the US Treasury iShares ETF. And so I started looking into it. And sure enough, that ETF is offered by BlackRock. And what do we know about BlackRock? Oh, shoot, that's not the right article. Sorry about that. Coinbase selected by BlackRock to provide Aladdin clients access to crypto trading and custody via Coinbase Prime. Over the past few years, Coinbase has played a central role in developing and strengthening crypto markets as the safest, most trusted bridge to the crypto economy. Today marks an exciting next step on our journey as we announced that Coinbase is partnering with BlackRock, the world's largest asset manager, to provide institutional clients of Aladdin, BlackRock's end-to-end investment managed platform with direct access to crypto, starting with Bitcoin, through connectivity with Coinbase Prime. Coinbase Prime will provide crypto trading, custody, brokerage, reporting capabilities to Aladdin's institutional client base, who are also client base of Coinbase. Built for institutions, Coinbase Prime integrates advanced agency trading, custody, yada, 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 that supports the entire transaction lifecycle. We combine these capabilities with leading security, insurance, and compliance practices to provide institutional clients of Coinbase a full-service platform to access crypto markets at scale. Coinbase's clients include hedge funds, asset allocators, financial institutions, corporate treasuries, and other institutions. I wonder if that is somebody like Bailey Gifford, an Edinburgh-based management firm who now got $100 million to be allocated to their bonds. So very, very interesting. So BlackRock, wrong order. Coinbase right here. Our scale, experience, and integrated product offering represented what BlackRock believed to be a logical partner for Aladdin. Our institutional clients are increasingly interested in gaining exposure to the digital asset markets and are focused on how to efficiently manage the operational life cycles of all these assets. The connectivity with Aladdin will allow clients to manage their Bitcoin exposures directly in their existing portfolio management and trading workflows for a whole portfolio view of risk across asset classes. So interesting. Coinbase Prime is the leading institutional broker platform for crypto assets, trusted by 13,000 institutional clients. 13,000. And now those clients were asked by the FDIC if they were planning on engaging in crypto-related activities or if they had been engaging in them. What do you think these guys are going to report? There is no laws right now saying they have to do anything. So I just ask yourself that question. What do you think they did? 13,000 institutional clients buying crypto, not having to report it to the FDIC or anybody else. The day will come when they have to report it, and that's going to be when they are going to try to be selling it back to you at 10 times the price it is today. I can already see the writing on the wall. So these guys have 13,000 institutional clients buying up all these dips. The markets are being fudded, just driven down. So the institutions can get in and buy all these assets. Coinbase's prime custodian, Coinbase's custody trust company, is qualified custodian and a New York limited purpose trust company regulated by the New York Department of Financial Services. Basically, the hardest state to get clarity and qualified in is New York. So we have Coinbase tied in with BlackRock. So they're going to be holding all of their assets, which is almost $10 trillion right now. You have MakerDAO moving over to Coinbase for custodying their assets. And then, the BlackRock, I was looking into the iShares, and what do you know? In July of this year, these guys launched their ETFs for ESG. So I just started looking through here and it was hilarious. Sustainable investing is about investing in progress, recognizing that companies with a more sustainable approach to business may be in the best position to grow. At BlackRock, we're committed to making sustainable investing as straightforward as traditional investing. Whether you seek to eliminate exposure to controversial business activities or prioritize investing in companies that embrace high environmental, social, and government standards. We've created a simple ESG solution for Australian investors. Expect more when you partner with iShares, the world's leading sustainable ETF issuer. So if you're in Australia, I pulled this up earlier, and if you're in Australia, you have access to all this. And I don't know where it was, but it showed when these ETFs were released, and very interesting. This announcement came, their partnership with Coinbase was August 4th, and then 10 days later, they come out and they release their ESG ETFs. It was like August 14th. So BlackRock is now pushing ESG in Australia. So if you are an accredited investor in Australia, you can buy into all of these ETFs that are going to very, very soon be hosting cryptocurrencies in them, I believe. Not financial advice, but I was reading through this document here, and from July, and it just talks about, where is it? The ESG, the ETFs, how they work. And it's so funny when I'm reading this, just the first on page 4 here. I mean, it's when Richard was talking about how that these disclosures are bullshit. I mean, it is so true. I mean, look at this. I mean, the first everywhere here, BlackRock is a wholly owned subsidiary of BlackRock Inc., but is not guaranteed by BlackRock Inc. or any Inc. subsidiary or associated entity. Neither BlackRock nor any member guarantees the success of the fund, yada, yada, yada. I mean, just pages of this stuff. And who really reads this? I mean, it's horrible. It's just, yeah. So getting into this, it just talks about how everything is moving towards the green narrative, how, businesses are risky if they're not following these new agendas. Basically just lays out funds and what they're trying to do. And very soon there's going to be cryptos in these funds. It's not long. So Australia is where everything's being piloted. And so Hedera Hashgraph announces partnership with Open Zeppelin, a recognized leader in Web3 security and auditing, has integrated its Defender and contract services, enabling Australia's second largest bank to secure its ASDC stablecoin on the Hedera network. So right in Australia, we now have exactly what the FDIC article was talking about. The CBDCs and the payment stablecoins and stablecoins hosted on a distributed ledger that's accessible to the public. And New Zealand chose Hedera. I mean, there's very few options out there. I mean, it's going to be Hedera. It's going to be XLM. It's going to be maybe Casper. I mean, there's very few choices out there. Quant's going to be at the heart of this. But also right here, Australia's leading point of sale technology provider, Eptos Australia, has revealed ambitious plans to roll out blockchain-powered autonomous vehicles and smart cities in Australia built on Hedera's Hashgraph. So, I mean, all the stuff that they're piloting is all in Australia is all on Hedera. And I know Hedera is also working with India to do their whole CBDC program. And I'm just starting to see the dots connecting everywhere. And then you also see right here, Aberdeen PLC joins Hedera Governing Council, cementing its vision for Web3 and client-centric fund management. So the global investment company holds $500 billion in assets, which will first move to make Hedera the technology of choice for investment fund tokenization. So it's all, the writing is on the wall right here. I mean, everything that this guy Martin Gruenberg was talking about, the regulations and everything that we need to be so careful about, because they can have detrimental effects, but also the positive effects they have for breaking down, the barriers to entry and getting rid of the friction in the system. I I mean, it's all happening right now in other countries. And when you're seeing it built on Hedera, and when you go to Hedera's website and look at just their governing council, and you see Boeing, IBM, Microsoft, all of these companies are on their governing council, the writing is kind of is on the wall. There's going to be 39 members on their governing council, and just look at the list. So you got Avery Dennison, Boeing, DBS, Deutschcom, IBM, Google, FTOS, ServiceNow, Shinhan Bank, Standard Bank, Swirlds, Ubisoft, UCL. I mean, and there's also 13 more spots that are going to be filled. So all of these companies are going to be using Hedera's technology to roll out all their smart cities, their micropayments, their central bank digital currencies. Everything is going to be running on these DLTs. And I think it's not going to be long before you see the green coins that are already ISO approved, that they're going to start allowing, I think, them first into these ETFs that BlackRock are doing. Now that Ethereum is proof of stake and it's green, it now passes the ESG narrative. So Ethereum can now be included in ESG ETF. And I think that's where this is headed. So, we're just behind. Australia is I think the pilot for where this is happening around the world. And also, this was super interesting. I didn't even know. I found this literally as I was pulling up these articles to talk about today. And the Bank of International Settlements, which, where is it? Sorry, no, they're a Ripple partner. There's just so much that I'm confusing companies, but the BIS's Innovation Hub has concluded its Project Genesis 2.0 in collaboration with Hong Kong Monetary Authority and the UN Climate Change Global Innovation Hub. The project sought to demonstrate how blockchain technology and the Internet of Things, that right there is Ripple. When you see Internet of Things, that is Ripple. They are going for all of the money. Internet of Value, Internet of Things. When you see that, Ripple right there. So Internet of Things can be leveraged in order to enhance the transparency around the green bond market. I did not even know what this was. I only knew now that we're starting to see all of the short-term bonds being bought up by stablecoins and backing stablecoins. So Genesis 2.0 explored the technical feasibility of developing digitized versions of green bonds using carbon forwards, also known as mitigation outcome interest. Additionally, the initiative set out to address the risk of greenwashing in the industry, as well as lowering the cost for capital for environment-centric projects. To meet conditions required for climate bonds to contribute to the 1.5C climate goal, the project proposes a new structure for a green bond. These are carbon forward instruments that the bond issuer owes to the MOI holder. The project led to the development of two prototypes of green bonds. Each was developed by a consortium of companies that collaborated on the project. These bonds are different from other investment vehicles in the way that when someone buys it, they get a bond that is attached to a pledge of tokenized greenhouse gas emission reduction units. The first one was a result of a collaboration between Goldman Sachs, Alinfra, and Digital Asset. This prototype demonstrated its ability to digitally track, deliver, and transfer MOIs along with tokenizing the green bond. The embedded IoT technology provides transparency at the source. The second prototype was developed by Interopera, Krung Thi Brank, Sam Wu, and Sungshin Cement. And I'm pretty positive that one of those, Shinhan Bank, what do you know? Hedera governing board member. So when I see that right there, that what do you call it? Shinhan Bank. Yeah, that was it, right? What was it? Oh, never. Okay, Shinhan. All right. Oh my God, where Sorry, I'm just these all sound the same. Samwoo and Sung Shin. So never mind. So the Samwoo is the Ripple partner. I'm 100% positive about that. Sorry, I just found this article right as I was gonna get on. It was just super interesting that this prototype employs smart contract and API technologies and is based on an interoperable host chain. So interoperability, that is the key. And Quant is the one, their overledger, I believe, is gonna be part of this with Ripple as well. So this initiative was preceded by Genesis 1.0, which was a joint project undertaken by the Hong Kong Center of Innovation Hub and the BIS in 2021. So you're just starting to see that Goldman Sachs was working on this, Ripple Partners, and um, it's just all happening right in front of our eyes, and they're using the whole ESG narrative to shove all this shit through, and it's terrible. It's all a joke. I don't know. I mean, we just gotta deal with what is presented in front of us, and it's very interesting to see that. I've been following close to what they're doing in Australia with HBAR, and they're partnering with Atma.io and the whole retail supply chain. And then you see them trying to run smart cities on Hedera's DLT. I mean, these are the platforms the stuff's going to be built on. And Ripple's has a DLT, or yeah, Ripple's DLT and Hedera's DLT are two of the best in the world. And I want to find the partners. Siam Commercial Bank and Neum. Oh, did I get rid of that article? I think I did. Sambu. Oh well. All right. Sorry, I'm all over the place for a second, but yeah, it's just super interesting that we have Coinbase and BlackRock partnering. So Coinbase is going to now custody $10 trillion of BlackRock's assets. And then MakerDAO investing $500 million in short-term US Treasury and corporate bonds to now back their stablecoins. Very, very interesting. So of the $500 million, 80% will be invested in short-term US Treasuries, and then $240 million in 1 to 3 years US Treasury. And they're all in the they specifically mention the iShares ETF, and that is BlackRock. So MakerDAO, Coinbase, BlackRock, the bond market, they're all holding hands together, and everything is done in such careful planning. The wording in this, I put it in the description in the video, the link to this speech. I highly recommend reading it. I mean, if you are familiar with the ESG and Ripple's, Ripple's terminology that they've been using for the last couple of years, it just stands right out with the ESG right off the bat. The first important element, it begins with social, financial, or economic need. And then you see, banking the unbanked and cross-border payments, and the writing is on the wall, talking about the payment stable coins that are coming and how they need to assist and complement the FedNow wallet that is going to be coming. Very, very interesting. So I just wanted to go over this speech and kind of talk about how BlackRock and Coinbase and the bond market and stable coins are all being tied together, and exactly what the CEO, John's, I forget his name, Rune, was talking about, that this makes today's Coinbase news another move towards centralized entities and assets, which seemingly runs counter to the remarks from Rune's co-founder that DAI should divest from USDC. And USDC partnered with Circle. and Circle has already sold their soul, and they have shown that they will freeze anyone's accounts at will. So it's just it's sad. It's sad to see. And then Circle's CEO Jeremy Allaire has no balls and just points out this was our right and our obligation as a regulated financial institution, but you didn't technically were required to do it. So you just cocked and you sold your soul and you took the ticket, and now you are part of the beast. So, don't get me wrong. I talk about this stuff because I want you guys to be aware of it, not because I'm supporting it and I can't wait for CBDCs to come. No, I talk about this so hopefully we can find ways to get around it and not be stuck, kind of handcuffed by it. This is coming. Our FedNow wallet was supposed to be here at the end of this year, and it's being delayed, and it will be here next year in the middle. I would say around March to Mayish, the FedNow wallet will be released, and that's going to be the first step towards stablecoins. I don't know if it's going to be I don't know how it's going to work, but it's all coming. You could see all the companies are all tied together with stable coins, with US. So DAI, the stable coin, MakerDAO, USDC, Circle. I wouldn't be surprised if they come hard for Tether. You're seeing a ton of heat that they are basically just printing Tether out of thin air. It's backed only by bad debt. So that's the black swan event I think is coming for Bitcoin, is that it's not green, and it's also supporting the Chinese, the CCP. And this was the last thing I wanted to talk about, was an article that was just talking about legislation and kind of a follow-up to the speech from the FDIC and the Transportation and Infrastructure Act. So this article was really good here. Will the new tax reporting requirements for virtual currency assets go into effect as planned? So this is talking about what the IRS stuff and them hiring the 180,000 new agents that are going to be carrying guns to come, steal your ledgers and make you, pay your taxes. It's really, really going to happen fast. So cryptocurrency brokers will have to start reporting transactions to the IRS in 2024 because of bipartisan infrastructure law that Joe Biden signed last November. This also means that companies will have to start putting work in next year. The infrastructure law, for instance, explicitly requires certain tracking and reporting to begin in January. I mean, that's 3 months away. Given that this is barely 2 months away, some close watchers of the crypto industry expect the Treasury Department and IRS to offer some kind of delay on the reporting requirements. For its part, Treasury is being a bit cagey on this point. A department official told Weekly Tax that the regulations were a priority and that the Treasury would release proposed regulations and invite public comment before any rules were finalized, which that's really good to see, that there's at least going to be lobbyists allowed in. There's going to be some kind of pushback allowed, and hopefully some meeting in the middle where Sam Bankman-Fried and this whole centralized party gets what they want. Don't forget the Lazarus Group too. Tintop, I actually I'm not familiar with the Lazarus Group, but I will look into that. Appreciate it. So more on that in a bit. But first, thanks for coming to the Getting Close to Fallback Time version of Weekly Tax. Oh, sorry, never mind. This is it right here. That was the end of the article there. So there lies the issue. That explanation from the Treasury Department helps to illustrate why some industry observers are expecting a delay. Those observers believe it's likely that the Biden administration will deliver those proposed rules by end of year, but asking crypto brokers to start reporting and tracking before final regulations. That would be a big thing to ask, they say, largely because companies would have to update their systems based on information that could then change in the future. Treasury and the IRS are also working on a new tax form deal, with crypto transactions, the 1099 DA for digital assets. Another question to ponder here, why is this taking so long? I'm surprised, says Lisa Zaringer. I keep asking about them and keep hearing they're far along. It's not just that the infrastructure law passed almost a year ago, and there still hasn't been any further guidance on reporting requirements. In fact, crypto observers have several more reasons why they're puzzled that the Biden administration hasn't gotten at least proposed regulations out the door. For starters, Treasury and the IRS had already been working on a virtual currency issues before the infrastructure law passed. So experts thought they might be able to get proposed rules out quite quickly, like within weeks, hopefully giving the regulatory process enough space that companies would be able to update their systems for January 23. And that, guys, that is not going to happen. If it does, I'll be absolutely shocked. Treasury and the IRS had been working on crypto matters in no small part because officials there believe that tax avoidance from virtual currencies increasingly was becoming a major driver of the tax gap. This is probably the number one thing that would increase compliance. And Zarlinga offered one more reason to be surprised that it's taken so long for this to be produced. There's no doubt that the IRS and Treasury have had a lot of issues of tax rules in recent years, but the pace of those regulations has slowed down a bit going into this year until the last couple months, with the administration now rushing to get guidance out on the new corporate minimum tax and other parts of the Inflation Reduction Act. For so long, they were in the middle of trying to implement TCJA, referring to the GOP's Tax Cuts and Job Act from 2017. Now we have the IRA. There was kind of a lull. Next year could get kind of hairy. Republicans remain favored, at least to win the House next month, and the GOP could easily gain full control of Congress for next year. And should that happen, conservatives are ready to go the mat and battle for fiscal changes, including possibly new limits on Medicare and Social Security, and making permanent the individual tax cuts from the TCJA, as Pro Budget's Caitlin Emma reported. That sets up another drag down fight over raising the debt limit, which has also happened the last time Republicans took the House when a Democrat was president. It doesn't seem likely Washington will make a decision on those individual tax cuts during the next Congress, given that they don't expire until the end of 2025. And that is exactly the timeline where I'm seeing for all of the CBDCs, the whole ISO standards, all of that needs to be in effect for 2025. So I do think we'd have a couple years. It's going to be phased in slowly, starting next year, the FedNow wallet, and then, the payment stablecoins, if that comes in, and the CBDCs. I don't know if those are going to be issued through the Fed wallet, or it's going to be it's crazy times we're headed for. But there could easily be plenty of jockeying over those tax cuts. The Republicans released a budget plan this year that would make the 2017 tax cuts permanent. So basically they're just going to be arguing back and forth, back and forth, back and forth. Nancy Pelosi took aim at the GOP tax cuts during a Sunday interview, calling it a $2 trillion tax cut for the high end, and arguing that Democratic policies these last 2 years were less inflationary than the TCJA. So basically, to sum it up, it was a big Friday at ProTax. Oh, never mind. That just summing up their article or their own company. But yeah, interesting. We got tornado cast scapegoats. They're the demonized North Korean hackers. Literally. That's one thing that I've been arguing is, how do you, as a company, right? They're gonna make you be on this new green standard, right? Where you got to adhere to all these new compliances. Well, okay, that's great. I'm willing to do that. But say I sell hats as a company, and I got to get my materials, and I buy those from a company, and I use a stable coin to purchase it. I can't have my competitors seeing that. There has to be some privacy in here. So, and I believe that the FDIC and regulators, they understand that if you're going to make businesses comply with this new system, there needs to be privacy that the existing system carries into it. So, we're just in such an interesting time. I mean, this can go so many different ways, and that's why I'm so, um, I guess, so what's the word? Um, I'm so just, I don't even know what the word is, but I stress the ISO coins and utility coins for the next bull run that are going to fit these narratives that the FDIC is talking about. Banking the unbanked. That's Ripple. Clearly banking the unbanked. The whole ESG narrative. You're seeing that with Hedera. HBAR is it right on their website. If you go there, you talk about their network and how green it is right on their website. Use cases, governance. I mean, it's all here. Tokenized assets. I mean, that's where everything's going. Goldman Sachs tokenizing everything. I mean, Goldman Sachs was the one who was at the head of Project Genesis, the initial one. And I had done a stream months ago talking about how Goldman Sachs was looking to tokenize $700 trillion in assets over the next 20 years. And that's where we're headed. And the start is the infrastructure for all of this to happen. And, when you see certain companies, their lingo and their I guess catchphrases or their little mottos, their narratives, when you see them in speeches and in articles, it's so obvious to me why they're there. They're put there for a reason to get those you familiar with banking the unbanked and cross-border payments and low friction. None of this stuff was talked about 10 years ago when I first got into real estate or business, and none of that. And it's just really crazy to see how the narratives and agendas can change your life and change what's in front of you. But that's everything I got for today. Me just seeing how BlackRock is tied in with Coinbase, and Coinbase is tied in with MakerDAO, and the whole bond market and treasuries and short-term treasuries now backed by, or treasuries backing DAI stablecoins. They're all working together to try to stop this sinking ship. And are they going to be able to do it? I don't know. A couple more rate hikes from the Fed, if they have 75 points in November and another hike in December, this market's going to get crippled. And, I'm playing for both sides. I'm preparing for, if that does happen, if they do hike rates, and this is just a little dead cat bounce before elections, I'll be ready to buy that dip, and I'll be ready if we do start to crash. And I'm ready right now if we bottomed, and if we're just in a massive consolidation phase right now. There's several coins that I've been talking to people about over the last month that seem to just have bottomed out. I don't know what further consolidation looks like, for some of these. I mean, obviously those are tiny little altcoins, but when you see charts like this, it just, to me, signals a bottom. When you have 5 months of going sideways and then shooting back up, and actually, Val was not the chart I was looking for. Sorry, Lunar Crush. I check Lunar Crush every day to see what streamers are doing and see what hex streamers are putting out the most content. I use this all the time to see what people are doing. It's a super cool website, and there's every coin you could think of has a community. I mean, let's FTX. Here we go. Let's see who's talking about them the most. So Mr. Whale and Don Picasso Yaka, the top FTX influencers. So, go block those accounts. So you can come here and figure out who the douchebags are. But so back to the price chart in Lunar Crush. I mean, this thing was absolutely when it launched, it was at $10. It's down 99.6% from its all-time high. You look at that chart and you're like, oh my God, that's a dead coin. But when you start to look closely at the last 6 months, I mean, that's a consolidation phase to me and capitulation. And the last 30 days, we've started to trend back up. Volume coming in and looking at the 1 year, that's to me is signs of, I mean, obviously this could just be a dead cat bounce, like I said, and we could continue to come back down. But coins that have utility are going to drive this next bull run. And like, let's look at Hedera's chart. It's the same thing with XLM too. These coins never really had a breakout in the last bull run. I mean, they did well, but Hedera went from 11 cents to 40 cents. Well, I did a 4x. That's not, Solana, that's not Luna, that's not Matic this past cycle. So these are the coins that I'm looking at for the next bull run, and I'm accumulating right now because what's the downside risk when you see a chart like this for the last 180 days? I mean, what's the downside risk here? I mean, obviously, yeah, we can have a nasty scam week, but when you're consistently holding levels, and we're at 6 cents, I mean, I would say here the downside risk is 40% compared to other coins. So when you have a coin that is down 90% from its all-time high, it's consolidated for months, and you can also stake it, which Hedera can be staked through your Hashpack wallet that you can download. It's a plugin into Brave browser. You stake natively through there, or you can use Stater Labs and you can stake with them. And it's like over 10% the APY right now, risk-free. So I have mine staked here through my ledger or through my Hashpack wallet, and 10.36% is the rate right now. So, no risk for staking. The downside risk for Hedera to me is minimal. And then when I see that they're partnering with the government in Australia, the second largest bank in Australia to secure its stablecoin, they are working with EFT posts to build smart cities, autonomous vehicles. Clearly their technology works. And then you look at their governing board and you look at the people who are on there, it's a no-brainer. So I consider Hedera must have for the next bull run, in my opinion. It's not financial advice. Maybe I'm crazy. Maybe I'm just looking in the total wrong direction. But when you see real world utility and great use cases combined with a good social media, a good community following, you have all the makings for an explosive bull run. And community is massive behind these projects. And that's why I love Hex. Hex has by far the most, I don't know if it's the biggest, but we are the loudest. We are the most passionate. And, the Hex community is what keeps Hex going. Hex would not be around the way Richard acts right now, the way he comes off to people that don't know him or have never seen him. Very few people are like, whoa, wow, I like that clown suit that guy's wearing. It's not a good look. And the community and everyone that's on here streaming and talking about delaying gratification and, being healthy and making smart choices, being kind, that community is going to drive Hex, and that community aspect is going to drive a lot of these next coins in the next bull run. And, I've talked about them a lot on here, the whole ISO list, of Casper, another coin that I've been trying to accumulate. The same thing as HBAR. I mean, look at the chart on this. I mean, if that's not consolidation and bottoming, then I don't know. I'm going to have to start learning how to reread charts again. So, let's see. That was May 20th to October. That's almost 5 months of going nowhere. And now we've finally broken out and started heading up. Casper is already ISO approved. They're in the trade messaging, trade finance, financial messaging ecosystem. And that's a $19 trillion industry that these guys are going to disrupt. And it's between basically Casper and Zinfin are the only ones that are doing this. And when you look and you see who they're partnered with what they're doing, and again, they fit the whole ESG narrative, and they already have the whole messaging system that you're going to need as a business. These guys have a plug and play for business NFTs, I believe, and XDC, same thing. So yeah, their Casper is basically going to have plug and play for business NFTs. You know, it's coming in the future. Businesses are going to need NFTs for simple utility, for running, you know, just stuff that is on current networks and hosted on networks. You're not going to need to do that anymore. One smart contract and an NFT solves all that. And Casper's at the heart of that. And when I look at the chart, it looks like to me it's bottom. The downside risk, yeah, obviously we could come back down to under 3 cents. So, you know, what's that? Almost 50%. But again, same thing with HBAR. Casper has staking from your ledger. You can connect it and stake it right on here. 10%, 10.46. It's gone up a little bit. Right through your ledger, zero risk, and you just stake it and forget about it. And I promise this feels identical to 2019 when I was buying Cardano and I was buying Polkadot. I was buying Kusama. I bought Civic. I bought Gnosis, and they were doing nothing. All of the charts just looked like this. And you know, within the next 6 to 8 months, once they started to take off, and then you own that bag and you're not chasing the pump, there's nothing like it. So, you know, do your own research. This obviously isn't financial advice, and I didn't want to talk. I wasn't supposed to talk about any coins on today's stream, but never know where the rabbit holes go. But, you know, legislation is coming. It might not all be that bad, but again, you know, it's moving towards centralization, and luckily we have Richard Hart, and we have the Hex and his ecosystem with Hex and Pulse Chain and freedom of speech, freedom of movement. Hopefully we can, you know, keep the decentralized aspect of things going, and we can make some noise with legislators, and some actual energy can go to the right lobbyists, and we can see laws that actually favor us instead of Sam Bankman-Fried and this new one world, you know, order that's coming. You know, I do not want that. I want to be in Hexaco and, you know, celebrating Texit and the Texan token with everybody, not using a CBDC, being told where I can go spend that money. So on that note, I will be back tomorrow morning, early 8:30 live stream. Blockchain Monkeys hopefully will be on. Also, Molly the Hexagon, and we're going to be talking about some gaming stuff, and want to kind of just switch it up a little bit each week and talk about some things that we don't normally talk about, and some Illuvium stuff tomorrow, some Zilliqa Metaverse stuff. So it should be a good stream, and want to just try to break down some walls and you know, make bridges to new communities, and not, you know, tear down any bridges that could exist right now. So all these tokens and protocols that are already set up in compliance will get more. I totally agree. It's in top, and it really just, it pisses me off when I see like hexagons in here just arguing back and forth about, oh, Zen, he attacked our vampire, attacked our community. Rah 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 rah. If people spent half of the time they did arguing about this dumb stuff and looked into Casper, into XDC, into Cosmos, and what they're doing with Tendermint and the WASM stuff, it's really fascinating. And, you know, if you found Hex, there's a part degen in you. You found Hex for a reason. You were an outcast. You were doing something different. So, I'm trying to get people's ears open and just at least so I can say you didn't know about it. You chose not to invest in it, or you chose to ignore it. So, Algorand, another one that we're going to be talking about tomorrow a little bit, or on Thursday if we don't have time. Algorand is doing a ton right now with layer twos, NFTs, partnered with FIFA for the World Cup. And the biggest thing is they are MIT's baby, Gary Gensler's baby. So you cannot ignore stuff like that. Connections to MIT are massive. It shows me that they can't fail. They will be put in a position to succeed. So that's all I got for today. We will see you tomorrow morning. Tin Top, my man, thank you for stopping by. Everyone else that watches this, appreciate the support. Like, share, subscribe, and follow us on Twitter if you don't already, Viber Finance. And this is the account, my goofy ass right here. And we will see you on the next one.
At Viber Finance, we seek out the hidden gems in cryptocurrency. We will tailor your portfolio to work for you. Are you ready to transition your investments from traditional markets to cryptocurrency? Are your coins staked and earning interest? Are you overwhelmed with all the jargon in crypto? Is your portfolio underperforming and you want to reposition into consistent winning blue chip coins and viable projects? Do you feel like you missed out on DeFi, Metaverse, and NFTs? Here at Viber Finance, we provide you with the data, skills, and tools you need to stay on top of the digital asset market. Viber Finance, we are the future of crypto.